Let me share a quick story. Do you remember the infamous incident with the trader Nick Leeson? He was a trader who single-handedly brought down Bollinger's Bank in the 90s by making massive risky trade without proper risk management or analysis. His story is a stark reminder that trading takes a lot of time, a lot of patience, and a solid understanding of market analysis. It's not something you will master overnight, but with dedication, you can definitely get the hang of it. Hi, my name is Lamia, and in today's video, we're going to dive into the basics of technical analysis for beginners. By the end of this video, you will have all the tools you need to build your unique trading strategy. But before we break the Bollinger Band or anything, I need to let you know that I'm not a financial advisor and nothing in this video is financial advice. Now, let's get started. First, let's talk about holding versus trading. Holding, or hodling as the crypto community calls it, is a strategy where you buy an asset and hold it for a long time. This approach is often seen as more straightforward and can be more profitable in the long run. Think of it like planting a tree and waiting for it to bear fruit. Trading, on the other hand, is like trying to catch a fish in a fast-moving river. It requires more skills, patience, and practice. While trading can be highly profitable, it's also riskier and demands a good understanding of market analysis. Technical analysis, or TA, has been around for hundreds of years. It all started with candlestick chart, which were invented by Japanese rice trader named Monahisa Homa in the 1700s. These charts helped traders understand market sentiment by showing price movements over time. Imagine trying to read the market mood swings. Candlesticks chart are your guide. TA is all about analyzing past market data, primarily price and volume, to forecast future price movement. It's based on the belief that history trends to repeat itself in the financial markets. So let's break down some key components of technical analysis. Volume is the number of shares or contracts traded in an asset or crypto during a given period. It shows the strength of a price move. For example, if a price movement is accompanied by high volume, it's considered more significant. Think of volume as the fuel that drives the market. No fuel, no movement. Next up, let's talk about support and resistance level. Support is like floor for the price, a level where it tends to stop falling and bounce back up. Resistance is like ceiling, a level where the price tends to stop rising and might fall back down. Identifying these levels help traders make better entry and exit decisions. Think of them as the bumpers in a bowling alley, keeping your trades on track. Trading patterns are formed by the price movement on a chart. They help traders predict future price prediction. Some popular patterns include head and shoulders, double top, bottoms, and triangles. These patterns can indicate whether a market is likely to continue in its current direction or reverse. It's like trying to predict the weather. Sometimes you get it right, sometimes you end up drenched. There are hundreds of different indicators that people use in TA trading. Some are free to use, while others you may have to pay for. Unless you want to become the next Warren Buffett, the free ones are more than enough. Here are 4 crucial TA indicators you should know: moving average, MACD, RSI, and Bollinger Bands. Moving average smooths out price data to create a signal flowing line. This line helps identify the direction of the current trend over a specific period. There are different types of moving averages, such as simple moving average, SMA, and exponential moving average, EMA. They are useful for identifying trends and potential reversal points. Imagine them as the GPS for your trading journey. The MACD is momentum indicator that shows the relationship between two moving averages of an asset's price. It consists of MACD line, the signal line, and the histogram. When the MACD line crosses above the signal line, it's a bullish signal, and when it crosses below, it's a bearish signal. Think of it as the market mood detector, happy or sad. RSI measures the speed and changes of price movement. It oscillates between 0 and 100 and is typically used to identify overbought or oversold conditions in a market. An RSI above 70 indicates that an asset is overbought, while an RSI below 30 indicates that it's oversold. It's like checking the market's pulse. Bollinger Bands consist of a middle band, a simple moving average, and two outer bands that are standard. Deviation away from the middle band, they help identify whether prices are high or low on a relative basis. When prices move outside the band, it may indicate periods of high volatility and potential trend reversal. Think of them as the market guardrails. There are many more indicators and tools available in the technical analysis, but these four are a great starting point. Remember, the goal of technical analysis is to use past market data to inform your trading decision. It's not an exact science, but with practice, you can develop a strategy that works for you. Thanks for watching. If you found this video helpful, please like, subscribe, and hit the bell icon for more updates on your favorite cryptocurrencies, and see you in the next one.